All right, guys, how are you? I am here with Jim O'Shaughnessy, an absolute legend on Wall Street. He's laughing as I say that, which means that it's probably true. Jim, thank you so much for joining us.
Well, I can tell you that my wife and children say I am a legend in my own mind.
That's half the battle, actually. No, I'm super excited to have you. I think a lot of times we spend time talking with people who are in the decentralization, kind of cryptocurrency industry and mindset. You have a very different background coming from a long career on Wall Street and in traditional finance, and so I'm excited to hear what you kind of think about all of this, the hoopla and hype around crypto.
Sure. Now, glad to be here.
So for those that don't know you, why don't we go through your background first, and then you can make it sound as legendary as you would like.
Well, actually, I came up as a young guy. I fell in love with the stock market at an early age. That's kind of weird. But I grew up in St. Paul, Minnesota, and we had a family foundation. And they would once a quarter have meetings for the foundation in St. Paul. And when I got to be old enough, they invited me to the dinners. Bunch of Irish people. You can imagine how those dinners would go. But I was listening to my uncle and father argue about the merits of IBM.
Mm-hmm.
And they were talking all about whoever the current CEO was then. Everything that they were describing was people. And I'm like listening to this thinking, I think that that's an awful way to buy a public company. Maybe if you're doing a startup, the people matter a lot more. But if you're buying one of the biggest companies in the world, I think numbers are more important. So I went down to the James J. Hill Library, which was a great reference library in St. Paul. All the railroad barons set up these enormous libraries, and so they had everything. Originally, I grabbed the S&P tear sheet book, which has 500 companies in it, and being potentially one of the laziest people on the planet, decided that that was not going to work out for me. So I thought, why don't I just look at the 30 stocks in the Dow?
Mm-hmm.
And so I found a book there that went all the way back to 1885, and it showed every single component of the Dow from 1885 forward. And learned a lot of really interesting things. For example, they kicked IBM out of the Dow before it went up something like 30-fold, and they replaced it with AT&T, which went up 1 times. So, had they left, certain stocks in the Dow would be vastly higher today. Anyway, what I did was I listed the 30 for each year, and then I just did the standard numbers: price to earnings, dividend yield, price to book, all of those things. And literally, this is 1978, I had to do this by hand.
Amazing.
On a big paper spreadsheet. And so I got an inkling that not paying up for a stock was a good way to invest. I did a comparison between the Dow stocks with the highest PEs versus the lowest PEs. And there was no comparison. Buying annually the 10 with the lowest PE just absolutely obliterated the 10 highest PE stocks. But then I also looked at dividend yield. I ultimately wrote an article for Barron's in 1993. You might be familiar with the famous Dogs of the Dow strategy. Mm-hmm. Well, I took that back to when the modern Dow was created. There were a couple other books, so I do not claim credit for having invented that strategy. But the other books only really went to the 1950s.
Mm-hmm.
And so I thought, well, the Dow's been around since the late 20s. Let's go see how it does, and we'll have this huge out-of-sample holdout period to see whether it works then as well. It did. And of course, I'm an 18-year-old male. I had other interests, including girls and parties and all of those things. So I kind of set that aside. Went to college and then met my current wife of 36 years at a college summer party. Graduated college and then started back in earnest. And now I had computers, so now I was really dangerous.
Now you're rocking and rolling.
So I got hired by a big pension fund in the Twin Cities called Control Data. It was an old conglomerate, and back then, the dark ages really were dark. A lot of people didn't even know what style their portfolio manager was using. Were they growth? Were they value? Were they growth at a reasonable price? All of these things. And they said, we want you to come in and make some sense of this for us. So I founded the company O'Shaughnessy Capital Management in 1987 to do that. And we created what were called normal portfolios. They're like highly specialized benchmarks. It's not like using the S&P 500 or using the Russell 1 value, as a kind of a general benchmark for how a manager might be doing. What we did was take the manager's portfolios, put them on a database, look at the most extreme differences in their portfolio from that universe, and then use the most extreme differences to screen the same universe for a portfolio of stocks that looked, acted, and most importantly, performed like the underlying manager. The whole purpose of a normal portfolio was really simple. It was, is this manager, through his or her activity, trading, selling, buying, adding any significant value to their underlying style, or is it all the style? Well, what we found was my kind of aha moment. Even though we attributed huge transaction costs to the portfolios that we created as the normals, they killed their underlying managers. And I don't mean just by a % or two. They absolutely destroyed them.
Why?
Because this was the inkling of, I wonder if that cartoon by Kelly is right, Pogo, we've met the enemy, and it's us. And that's when I started to develop the theory that basically human beings are designed to suck as investors, right? So we are optimized towards a history that no longer exists and hasn't existed in eons, right? When we're out walking on the savannah and we see a bush rustling, it's probably a very good idea to turn around and run like hell, right? Because you don't know what that is. It could be a predator, it could be something else, but you're not going to take your chances. You're just going to run.
Yep.
Well, all of our ancestors, of everyone sitting in this room, ran. So the ones who didn't run, the braver, all got killed. And so that made us optimized to be very, very fearful of perceived threats. And so when markets, as we know, are incredibly volatile, what do people do? The amygdala takes over, the fear takes over the brain, and there's almost nothing you can do to fight it unless you are a quantitative investor who does not override their model, right? So I started reading a lot of what is now known as behavioral finance. Actually, I found a book by a guy by the name of Robin Dawes, a Brit, who his book was actually about psychotherapy, but he had a great chapter about all of the studies that had been done over actuarial outcomes, i.e. algorithmic outcomes, and clinical outcomes. That means I'm the doctor diagnosing you. And when they started all these things in the 50s, they all of the researchers thought that the human expert was going to soar above these simple algorithmic solutions. The algorithmic solutions destroyed them. And they destroyed them for one reason and one reason only. They were consistently applied time and time and time again. We humans are far more interesting, right? We get hungover. We have a fight with our spouse. We're in a bad mood or we're in a good mood. And we let that influence our decisions in financial markets. There's a study that just sticks out in my mind, and that is about people trying to get parole. If you want to get parole, make sure that you are one of the first appointments of the day. The people who are at the 8 to 10 in their hearing, they get parole at something like 85% of the time. Guess who almost never gets paroled? The people whose appointment is right before lunch. And why is that? The judges are hungry. And so they're like, nope, time for lunch. And, it's amazing, but I've collected these examples over the years, and I often say to people, we have known about this for a long, long time. One of the best books that I think every new investor should read is Reminiscence of a Stock Operator, the fictionalized life of Jesse Livermore, who was a big trader back in the 20s and literally was short the market going into the 1929 crash. He had to hire security guards because people wanted to tear him limb from limb. Because again, if you understand human history, if you understand human psychology, we all look for a scapegoat, right? We had very famous scapegoats during the financial crisis, right? And that hasn't changed at all. And so he had to go into hiding. And ultimately, the real sadness of Livermore is he ended up killing himself in the Sherry Lehman Hotel here in New York because he finally had that last trade, which bankrupted him. And even though he knew, right, and his whole book, Reminiscence of a Stock Operator, is all about nothing ever changes. The same thing that led Isaac Newton to buy in at the top of the South Sea Trading Company back in the 1700s is happening to us today. So I always say different players, same play.
Yep.